All right, good afternoon. Welcome back here to TMAnalysis. Great to have you aboard. We'll go ahead and take a look at some of the market metrics here with you, as well as some of the trade candidates that are out there. And I believe market metrics are very important right here because we're not seeing a lot of differentiation in the market. What does that mean? Well, it means bottom line, if you go out and buy, J.P. Morgan, you're probably just as likely to have success on that as you are to buy Boeing. And it's going to matter which way the market goes. The market goes up, JP Morgan and Boeing are going to go up. Market goes down, they're both going to go down. We're probably not going to see a high level of differentiation coming in until we see the market metrics turn. And at that point, I think the level of differentiation is going to be massively high. Because one of the things that this market correction has done, or bear market, whatever you want to call it, it has really shaken things up to the point where fundamentals are very out of balance. And so what happens? Well, when you start to get some stabilization, fundamentals start to matter. You see fund managers moving into the undervalued areas, and we are going to be looking at those a lot here as we get into next week. Been putting a lot of stuff together here on that, and this is one of the biggest disruptions that we have seen in many, many years. And what do disruptions create? Disruptions create opportunity, and I believe there are so many out there that are better opportunities than we have seen in a very, very long time. But the reality is, we can't go out and say, well, Apple's undervalued. Apple's really great right here. Here's why Apple should be bought right here. And Apple, blah, 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 without saying, oh, man, if market goes down 80 points tomorrow, Apple's going to go down $8. Apple may not have any news. It may not be any merit of their own. It may be positive for Apple, may be a negative for Apple. The market's down 80 points. Apple's going down, and vice versa. If the market goes up 80 points, Apple's going to go up. So what do the fundamentals really matter right here, right? They don't. They don't in terms of if you're looking at things really short term. If you're looking from an investor side, yeah, you start looking at things like Apple down here around 150, and you go, look, I'm very, very tempted for XYZ reasons. Now, so that will be coming. When will it be coming? Is it coming, this week, next week? Well, for me, it's about, okay, when do the market metrics shift? And if we see the market metrics shift, then we will see, a higher level of differentiation. Until then, most trades, you're pretty much just playing the market one way or the other. Today, bullish percent index has risen 21%. Well, that's a huge number, right? Well, when it comes to the bullish percent index, a 6% move creates a bullish signal. And if we look at what the low was right here the other day, and we look at where it's at right now, the bullish percent index has created a bullish signal. Yep, it didn't go up very much the last 2 days with the market moving up big. Not entirely uncommon, but today with the market flat to semi-down, bullish percent index is moving up and giving a bullish signal. We haven't seen this in a long time, okay, in terms of just the month of December. Now, if we go and we look historically after corrections, right? Historically, when we come off of the bottoms, and let's just go back to 2000, and let's go back to 2010. This is flash crash, that Greek stuff, European debt stuff, summer of 2010. I know it happened in 2011 and 2012 as well, but if we come here and we look at the bullish percent index and we just clean up the chart, sorry about that. I really like stock charts, but there are a few functions I wish they would change or add. Let's see here, 2010. Here we go. And if you look, the bullish percent index came down here to to about 40, right? And fell, came on down sharply. I understand it's nowhere near where it is today, but the index is also a little bit different than it used to be. But you'll notice it wasn't its first move. It's one of those. The bullish percent index is one of those where it tends to. It tends to, yes, create a bull signal and have a reactionary bounce higher, and then create another bear signal, a higher low type of scenario. And so when we look at where the bullish percent index is right now, it is creating a bullish signal. Right, and I know it is not the season for big change and all of that, but the metrics are what they are. We have the bullish percent index creating a bullish signal here today, so that's going to help to switch the metrics a little bit. We have some other kind of short-term, really kind of short-term elements. Number of stocks trading above 7-day moving averages. It's pushed up into that 80% range. When you see stocks come off the bottom, this is typically the number you see. You see it push up into the 80% range of number of stocks trading above the 7. You'll notice we didn't see this on day one or anything like that, but we are seeing this metric change. We also will start to see about 60% of the stocks trading above the 20-day moving average. But here, we only have 52 of the S&P 500. 10% of the S&P 500 is trading above the 20-day moving average. That is an absolute product of the depth of the correction that has been. This is a very, very unusual number, meaning it's a number that we almost never see when you get a fresh new bull signal in the market and everything's all clear to go. So while the bullish percent index, and while the number of stocks trading above the 7, both in square bullish territory right here, it's not everything kind of doing the same thing. And we have the number of stocks trading above the 20 at an absolute abysmal number. That is absolutely a terrible number. When you look, it's kind of a surprise of what some of the stocks are that are above it. Caterpillar? Amgen? Really? Okay. Kohl's? Intel? Wow. Nike? Okay, they had earnings. Qualcomm? There's some interesting stocks in here. Walmart? Yum Brands? I think this is actually a pretty decent list where if you're trying to make a bullish watch list for going forward, this is a great list. These are stocks that on this bounce, the 10% of the few that on this bounce were able to recapture their 20-day moving averages. That tells you their bounce is a little more material. It's a little more, there's a little more divergence in the charts here with it. And it's a great place to come in and go, if you're looking this weekend to go and build a little bit of a watch list to say, hey, you know what, this, that, and that, this is a great place to start because this is where we're starting to see a little bit of differentiation. There's not mass differentiation, but this is where the magnitude of the drop and pop has created a little bit of imbalance here to where you can start to see who's shining a little bit. Who's really kind of shining a little bit. The Home Depots of the world, the Caterpillars of the world. They've had some very intriguing action this week. It doesn't mean I'm going out, rushing out, buying them right here, right now. They're not. Let's face it. They're not great risk-reward scenarios. They just aren't. And it's not like you can go and buy Caterpillar and with any sort of technical, real technical work, say, well, I'm going to buy Caterpillar. I'm going to use this level as a stop. Right? There is no real technical level, associated here. It's one where, yeah, you can pick a level, right? But, you could also throw a dart, and that's about what it is, with some of these. But as far as, stocks that will have the propensity to outperform going forward, yeah, I think you can start looking at this list and saying, hey, There's some really interesting ones on here. Home Depot, Lowe's, Nike. Let's not forget Lowe's has some new activist investor activity. Yum Brands, Walmart. These are positive stories. These are stories that we haven't seen the story change on them during this correction. One that's just absolutely amazing to see on this list is General Electric. We talked about GE and the fact that the J.P. Morgan analyst finally took off his bearish call. Finally removed his bearish call off of GE. We're going to see short covering come in, and we've seen a little bit of that, but this is one of the few stocks showing some some real technical basing here of late. I don't think the selling is over, meaning I don't think you can buy it right here and say, oh, it's never going to tick down. But it is, it's one of that list of stocks trading above the 20. So, while that element is squarely bearish, number of stocks trading above the 20, is still squarely bearish. There's a real kind of bullish theme to be taken out of it in terms of which stocks are above those 20-day moving averages. The volatilities are still incredibly high in whichever way you look at it, whether it be the VIX, VXX, but we are seeing the VIX, coming on down again here today, pushing back below 30, and the VXX, which was outperforming early, pushing into a little bit of an underperform here. We're still not seeing any real dramatic drop. Now, what does that mean? That means investors are not pricing in lower volatility in the future. That's what when the VXX is rising, essentially the story is investors are pricing in higher volatility in the future. When the VXX is falling, investors are pricing in lower volatility in the future. The VXX is something I would really like to buy some puts on for the challenge. And, you can see here if you look at some of the options, if you give it any time, they're pretty expensive. You can go pretty far out of the money and make a bet that it's going to, go through a kind of a landslide fall, break below 40 here. But, generally when we see the VIX move like this or the VXX move like this, it tends to take a few months for it to really kind of start to work things out. So, buying a 3-week option to me doesn't make a whole lot of sense right here with how it's priced. But bottom line, we see improvement in the metrics. The metrics have improved, here this week. And they have improved enough to put the market vibe into a neutral position. The volume element has gone neutral. The sectoral movement element is still bearish, but not as bearish as what it has been. If we look at things like the SPY versus the IWM, let me kind of show this to you here. This is one that, I think is very important and historically really has been. You'll see that the IWM is down 12% in the last month. SPY's down 8.5%. So it's not like it's in a bullish situation. A bullish situation is where the IWM is outperforming by 2%. So this is still in a bearish situation. But if we start to narrow this time frame down and we go from a month to, 15 days, cut it in half, right? You'll notice that differential between the SPY and the IWM, it's nowhere near the same. It's actually in a much more neutral territory. If we come down to the last 7 days, you can see that it's pretty much only a 1% difference. So we're not seeing over the course of the last 2 weeks, we're not seeing the IWM have the same sort of lag. It hasn't started to lead in any kind of major way, but it's not having the same type of lag that it has had. And if we come in over the last 4 days, pretty much this week, you can see that the IWM is actually outperforming, right? barely, but it is outperforming here overall, and so we're seeing a little bit of shift in that metric. It's not shifted to bullish advantage, but it has shifted a little more neutral than what it has been overall. And anyway, that's that's where it's at. So market vibe right here is a -6, and that is pushing it to a neutral. It would need to be a -4 for it to turn bullish, but right here, and it need to hit it by today to turn bullish. But right now it has turned neutral. And what does that mean? What's the implication? Well, I don't read any directional implication from it. I do read that we are going to see a compression in the movements, meaning we're going to go from some of the bigger movements, and the movements are going to get smaller as we go forward. That is what the metrics suggest. This is the first time that we've seen in this sell-off this month that we have seen the metrics suggest that the moves are going to get smaller going forward, and that's what we are seeing. We are seeing come into play here today. So that's some of the shift. Now, trade candidates, right? There's a difference between everybody in the pool, everybody out of the pool, right? And you go buy Amazon, and if somebody tells you the market's down 5%, you're going to say, well, Amazon's down big. If someone tells you the market's up 5%, you're going to say, well, Amazon's up big. There is no differentiation. The market metrics shifting a little more neutral suggests that differentiation could start to emerge, could start to come in. I get a little more interested, right? Option values are still insane. They're just still insane. I mean, the VXX, whatever we want to go look at, the option values are pretty escalated out there. But whatever sector we want to go look at. So, if you're interested in buying oil, right, and you're interested in something like a Caterpillar, and let's get the volume here. And sorry about that. Let me adjust it here. Let's get the volume separated out. But here you are on a Halliburton. Okay, it's bounced a little bit, right? It's gone from 25 to 27. It's made a small move higher. 25 to 27. I mean, that's almost a 10% move with how the stock is. About an 8% move there. Do we have any major bottoming volume? No, we don't. Do we have a higher low? No, we don't. So if you wake up on Monday morning and Halliburton's down 50 cents, do you feel comfortable holding it? Probably not. Probably not. There are a lot of things that just simply look like this. And yes, if the market continues to bounce, Halliburton's going to go up to 29, and there is that potential. Right, we can come in and start to look at the MACD histogram, start look at some other momentum oscillators. We could talk about positive divergences. We come into the options here on something like a Halliburton, and we come and we look at it. It's an implied volatility of almost 50%. So basically, to buy an at-the-money option, I mean, it's an insane number here. This is an option that should be worth about 90 cents, and it's worth $1.40. And, it's just that way across the board. So, all right, can I really take advantage? Well, if Halliburton jumps $2, right, my option is going to go from $1.45 to $2.80 theoretically, right? $1.45 to $2.80 theoretically. But what's going to happen? We're going to lose Vega points, right? We're going to lose 3 points for every percentage on the delta. So if we jump $2 and we lose about 10 points on the delta here, or on the Vega here, we're losing about 30 cents on our option. Okay. That's not too bad, in and of itself. But then when you take the theta, into account here for it as well, you're looking at pretty much, if it goes your way, you're going to get trimmed off 50 to 60 cents off your gain. So instead of going from $1.40 to $2.80, it's going to go from $1.40 to $2.20. All right, you're still making money there, right? But is that enough of a gain to justify the risk of waking up and seeing Halliburton down $2 and, you sitting there with that 80% loss? And that's my point. There's upside to be had. There's, you can get up. There's options. They're moving, and there's appreciation. Is it enough to justify the risk factor? And for me personally, no. For me personally, it just, it hasn't been. I mentioned yesterday that I grabbed some Nike, right? And it's not like, it's not like Nike is going down, and it moved up after I got in and everything else. But take a look at the options here. Take a look at the options here on Thursday, right? They're in the 220. They came down to 140 near the lows. That's not where I got them. But, the options really haven't done anything. They've actually gone down from where they closed yesterday, even though the stock is higher. And that is going to be the case for a lot of things if the market stacks on days like this. So that's an additional risk that you have to factor in there to the options. So, there are some directional things like a Halliburton where you can say, yeah, you know what? It could easily go to 29. To see that snapback back to 29, you can make a pretty decent argument. Is it worth the risk reward with the options? For me, absolutely not. For me, it just doesn't make any sense at all. One stock that I think is incredibly undervalued has gone from a relatively expensive stock, but deservedly so, to absolutely getting thrown away in a major way is FedEx. Here we are with a little bit of a relief bounce on low volume. Ugh. Is that what you feel comfortable buying into? For me, no. But look at how oversold it is. It is so oversold that I can't go short it on this relief bounce, right? Maybe on a gap lower on Monday, perhaps. But, it is one that could still relief bounce up to 180 or something of that nature. And then even if we were to go and map out every technical here and say, look, the odds are 65% of this and 35% of that. Even if we were to go and do that, would the options be justifiable? Would the options justify the trade? A 14-day trade on a $160 stock, 10% spread. A 10% spread, that means we're not going to be able to get in and out very easily. And, it's something where if the stock goes against us, it's going to be a big ouch. And if it goes our way, we're going to lose a little implied volatility, albeit probably not as much as we're going to lose on Halliburton. It's in a little bit better of a situation than what it's been. But is it still a great scenario? No. No, it's not. If I'm super bullish and really think this is going to 180, yeah, those options make some sense. We can buy a $4 option. It can go to $15. It can go to $20. There's that potential there, but you've got to be right. You've got to be right in a big way, and essentially you have to be kind of expecting, something that isn't, normal, right? That isn't normal, which is more probable than what it has been. My point is what? My point is the fact there is no differentiation, right? And, I go out and I look at the stocks that I think are very undervalued here, and I go, okay. And then I look at the options, and I go, ugh, right? And so bottom line is I'm going to hold off here. I'm not going to enter anything into the close. I think I could go buy some CSX and have some decent potential. But a lot of these types of sets, a lot of these types of looks that we see out there in the market today, you gap down on Monday, you want to be gone. And the fact of the matter is the tendency is that for the last day of the year, for there to be some sell action in the last hour, that's the tendency. And, can I pick up CSX at 61, 60, 60 and a half? In that case, and my suspicion is yes, because very little, really has a higher low coming into play. So the market metrics have moved enough that I'm willing to start looking at some differentiation type plays. Look at, say, hey, you know what, this stock may outperform another, but it hasn't moved enough to really expect that and to really kind of say, all right, you know what, the big waves are gone, and a lot about what I talked about yesterday is still highly in play. And so I'm going to go into the close here still with cash, and I know that's boring. It's boring for me at least. But we'll look at it Monday. Monday morning. Monday is a full trading session, last trading session of the year. There's going to be a lot of price action that has nothing to do with what happens, come the new year. But one of the big tendencies that we see in the market is that the gap on the first day of the new month, and I'll talk about this next week, and hopefully we'll get a chance to play it. That gap tends to be very meaningful. And so we'll be looking at that and assessing that, and hopefully that comes with a little bit of cheaper option values. Some things like Bank of America, they are getting a little bit better in terms of option value. Caterpillar isn't as ridiculous in terms of option value. Even Visa, not as ridiculous in terms of option value. But, overall, they are still highly, highly elevated and, very contingent on the next direction of the market more than they are, okay, you know what, investors are buying this and they're buying that, and differentiating here and there. Thanks for hopping on. Have yourselves a great one, and we'll talk to you later. Take care.